Okay, welcome. So this is part three of the 5 strategies that I use on a day-to-day basis. In this one, we'll be covering FVGs and IFVGs, why they're important, how to use them, all that good stuff. So before we get into this, actually, a few of you are asking in the previous video, what indicator did I have on my chart? Well, it's a custom indicator that I've built. It covers liquidity sweeps. It marks out automatically untested session highs and lows, automatically marks out fair value gaps above price and below price. It marks out inversions. So when price is about to reverse, it automatically marks it out for you. It has the PO3 candlesticks right next to price action. We'll be covering that in the next video. It also has a mixture of fixed range volume profile as well. So if you want access to that, you can just jump into the Discord and get access to it there. But let's jump into FVGs and IFVGs. Okay, so we're going to be covering fair value gaps first, just defining what they are really. So a fair value gap is an inefficiency in price created when the market moves so aggressively that it leaves behind an unbalanced area where little to no trading occurred. It appears as a 3 candlestick pattern where the wicks do not overlap, signaling that price expanded too quickly for buyers and sellers to transact. Because markets naturally seek balance, price returns to these gaps to rebalance liquidity, making FVGs high probability areas for potential entries in the direction of the trend. So over here we have a bearish FVG and a bullish FVG. So it's a 3 candlestick pattern. You need 3 candlesticks to create an FVG. Over here, we have the bottom wick of the first candle, and we have the top wick of the third candle. The gap is on the second candle, which is in the middle. This wick and this wick do not touch at all, creating this gap. Likewise, on the bullish scenario, on the first candle, the top wick, and on the third candle, the bottom wick, do not touch, leaving this gap in the third candle. So how do fair value gaps work? After an imbalance in price is created, price often returns to fill the gap, filling orders that did not fill on the previous move that created the imbalance, creating buying pressure when the price returns to a bullish fair value gap and selling pressure for a bearish fair value gap. So to explain that in a bit more detail, on the way down, lots of people were selling. And in this gap, because price moved so aggressively, some people that were selling, not all of them had their sell orders filled. So as price comes back up into the bearish fair value gap, all of those orders, those sell orders that did not fill, all get absorbed by this buying pressure. So through that buying pressure, the sell orders absorb it, forcing price back down. And it's the exact same in the bullish case scenario. So as price is expanding upward and a very aggressive move through this gap, some buy orders did not get filled. So as price comes back in to the bullish fair value gap, those buy orders are filled, adding pressure to absorb the sells and then push price back up. Okay, so you understand what a fair value gap is. Now it's important to understand the inversion of a fair value gap. So, what is an IFVG and how does it work? Well, an IFVG is a price imbalance that is created indirectly when a previous fair value gap gets violated. The market often treats this inverted zone as it indicated that the initial fair value gap's price direction has lost control and there's a shift in direction for price delivery. We use it as additional confirmation for the direction of a trade setup. So over here, we have an example of a bearish IFVG. So to start it off, you create a normal fair value gap. The bottom wick and this top wick left a gap in the middle candle, creating the first fair value gap. Now price has reversed, completely engulfing the gap on this candle, sending price straight up. This is a classic signal that price is reversing, and it's called an inverted fair value gap. Now, it's the same deal on a bearish case. Price has been delivering to the upside. We created a fair value gap. This top wick and this bottom wick left a gap in the middle candle. Then price reversed and completely engulfed this gap with this bearish candle, creating the bearish IFVG, indicating that price is reversing. Now you understand what an FVG is and an IFVG. Let's jump onto the charts and have a look at it in greater detail. So this is how we use FVGs and IFVGs in conjunction with the liquidity sweeps and with session highs and lows. So right now, New York is sweeping London session high. What we want to see is price close back below London session high. Ideally, it will create an IFVG followed by an FVG. We want to wait for price to then retrace back up into the bearish FVG and then distribute to untested areas of liquidity. So let's see how price forms. Okay, perfect. So you can see the indicator has already marked out the bearish FVG. It also marked out the inversion of that gap, and price has closed back below London session high. What we would want to wait for is price to come back into this bearish fair value gap, and then we'd aim to take out these lower levels of liquidity. So we'll put our limit order up here. Stop loss just goes above New York's high, and our take profit is at these lows. And we'll watch that play out. All right, our limit order just got filled. Let's see if it hits our take profit target. Just like that. That's a beautiful trade. So here's another example. We'd be waiting for price to sweep Asia session high. We'd ideally want to see price close back below Asia session high, creating an inversion along with a bearish fair value gap for us to then enter our short limit orders. And we'd want to target some lower draws on liquidity, which would be down here. So let's see how price plays out. Okay, we just swept Asia high. We'd want to see this gap invert now. All right, beautiful. We just inverted this gap. The indicator already marked it out for us. What we now want is see this bearish fair value gap, and that's our entry that we'd want for our short. So we'd come over here, put our limit order in. Our stop loss would just go above London high, and we'd be targeting this draw on liquidity. So let's see if price comes back up into that bearish fair value gap, filling our order, and then we take price lower. Wow. So that was a very quick trade, came back up into that bearish fair value gap and delivered straight down to our draws on liquidity. Let's see if we can find another trade directly after this. Okay, what have we just done? We've just swept Asia session low. We didn't create any inversions, but we have created a bullish fair value gap. Price has actually come down and tagged into it. That would be our entry confirmation. So we'd enter some longs. Stop loss would go just below London session low, and we could target these draws and liquidity just above us. Let's see how that plays out. Wow. Okay, so you get it. Using FVGs and IFVGs with liquidity sweeps and session highs and session lows works. It allows for a precise entry and a targeted draw on liquidity. In the next video, we're going to be going over PO3, so you can find that video somewhere up here. I'll see you there.